You won't believe what Blackrock just said about the stock market. It is a warning about the stock market despite their bullish positioning, which is really interesting because it's basically the opposite position that I've taken with a similar conclusion. Now, if you're not familiar with my position or their position, let's watch the video and find out what's going on. First, we're going to look at a chart that gives us a really good indicator of usually what happens when we're at this sort of point in the stock market. I do want to give a quick shout out. First of all, congrats if you also made some tendies this morning on that Tesla trade we made in the Stocks and Psych group. And if you're not yet part of the group, we have the next price increase and expiring coupon code coming up at the end of the month. So it'll be very simple, end of the month this month. And if you've got questions, email us at staff@mekevin.com. Let's get into it. This, folks, is a chart of the S&P's price to earnings ratio. Now, we're going to look at this before we look at what Blackrock says because they refer to it. Now, something that's really important to remember about the PE ratio is it does really weird things during recessions. See, in normal times, the PE ratio is useful because let's say we have $20 of earnings and we have $200 for a price of something. So something for $200 makes $20. That's obviously a 10 PE. Okay, that's really simple to and easy to understand. But what most people miss is that during recessions, this number goes up when the economy is faltering because not necessarily the change in price, but a substantially faster collapse in earnings. And so when earnings collapse, this PE ratio can actually skyrocket and make markets look very expensive. Watch this. Let's say earnings go, just to be extreme, from $20 all the way down to $1, and the stock market corrects by 30%. So we go down to 140. Well, instead of having a 10 PE, we would have a 140 PE ratio. So the point is, if earnings are collapsing faster than price, this ratio can skyrocket. And so there's a really unique conclusion that comes from this chart. First, let's go to the right over here and let's evaluate where we sit today. So I'm going to draw a line all the way across here, this little blue line, and this will show you that pretty much historically, we are at one of the highest levels we've ever been on the S&P 500's price to earnings ratio. As you can see, we are only beat by the crash of the dot-com bubble, which is the peaking that we have over here. And then, of course, we have the crash of 2008, which is the peaking we have over here. And then we have the crash of COVID, which is the peaking we have here. Now, remember, those are not the signal. We have to separate, as they say, the signal from the noise. The top of these charts is not the signal. What's actually the signal is what comes before those spikes, because you've got to look at how rich are prices getting before earnings collapse. Because once earnings collapse, it's already too late. You're in a recession. And so this is what's very interesting. Clearly, earnings are actually growing right now. Earnings at most companies are doing quite well, and the early reports that we got this morning were actually pretty good. Spotify beats, GM beats, Fiserv, which processes a lot of credit cards, like when you go to Macy's and stuff, UPS, Pepsi, all of them beat. Sherwin-Williams and JetBlue gave a little bit light guidance, but honestly, these were really good earnings. So we're not seeing our chart go up because earnings are collapsing. We're actually just seeing this chart go up because valuations are expanding. In other words, the market is getting rich. So what you really ought to do is you should look at times this has peaked before without necessarily a massive crash to get that subsequent like recessionary disaster. And instead, you want to look at what happened in places like this. Oh, over here, you had, that's not good, the stock market crash of Black Monday. Over here in the early 90s, clearly you didn't have a recession, but you had a valuation reset. Valuations went from basically where we are now way back down to a normal, historically normal level of around 15 times earnings. So 15 times earnings is right here, pretty strong support level. We saw that after COVID as well. So this elevated level where we sit now, absent an actual recession, is not very good. But Blackrock takes a different approach than I do on this, and I think it's really interesting because, well, it's Blackrock. They manage a whole lot of money. Now, I'll be clear. My strategy in what I think is happening in this environment is I think this market's gotten toppy. And this is just a very simple recap of the market being toppy. It's essentially you've got Bitcoin topping out, the S&P 500 and the Qs topping out, and that creates resistance that we really have to blow through. And I don't think we're going to. And so in the last few weeks, maybe the last 3-4 weeks, we've kind of started to seeing a little bit of an edge down. My concern is that worsens. And so I went to cash preemptively. Blackrock says, you know what? We're going to wait and then we'll flip-flop. And I'm going to talk about that flip-flop here. But some of you might be wondering, what was this Tesla trade I was talking about? What we did this morning is we actually set a day trader's line at 145.78 on Tesla. And what we noticed was we were constantly getting bounces here, 145, 145. And so that led us to go for a short and play this down to the VWAP, which worked perfectly. In fact, you could have literally done the same trade again when we got rejected, went for a double top, boom, right back to VWAP. And look at this. Then we even broke out above the line. And what happened? Boom, snap back to reality right there between VWAP and that day trade line again. Those are the sort of signals I send in the Stocks and Psych group. And while I can't guarantee you're going to make money on them because it comes down to how you trade, my goal is just to send, hey, here's what I'm seeing. What you do with it is up to you. And that's my goal. That's my job. All right, folks, let's now get into Blackrock. And make sure to join before the price goes up again and email us at staff@meetkevin.com if you need a bundle. Okay, right here, higher bar for US earnings. Okay, so let's read some of this right here. U.S. stocks have slid from their highs as inflation has proved sticky and geopolitical tensions rise. We eye whether corporate earnings can keep buoying sentiment. Think of a buoy in the ocean. It's full of air, and if the waves are too strong, or you attach a buoy to a boat that's filling with water and it's sinking, it's gonna pull that buoy underwater with it. Even in the case of a wave, just temporarily, because, well, hopefully there's nothing anchoring it down. We don't know if we're going to have an anchor or just a giant wave. But the point is, when somebody says things are buoying, it's usually not very optimistic. So the S&P slid on 3% on jitters from key tech earnings and rising bond yields, as well as geopolitical flare-ups. Yep, we already know that. First, when we got into 2024, we thought of two stories: cooling inflation and solid corporate earnings. Unfortunately, though, resurgent inflation might end up disrupting sentiment. And unfortunately, that's exactly what's happened, is we've gotten resurgent inflation. Just this morning, Jamie Dimon suggested we might end up seeing stagflation, and you should prepare for a case of stagflation, where the economy growth falters, we go to 0% growth, and on top of that, we end up having higher than normal inflation, which means the Federal Reserve can't bail us out by lowering interest rates. Instead, they end up saying, sorry, we stay high forever. It's not actually going to be forever, but until the economy actually really falters and crashes. So they say we stay overweight US stocks, yet are ready to pivot. Now, see, that's really interesting, and that's where I say it's a different strategy from mine. They are still long stocks, but they're ready to GTFO. And this is why. They say the second leg may now be playing out, reinforcing our expectations for persistently higher inflation. That raises the stakes for Q1 corporate earnings to buoy sentiment, just as higher bond yields pressure equity valuations. And then, here you go. The Fed is has gone from blessing the market hopes of inflation to 2% without a growth hit to implying policy may have to stay tight. And the S&P 500's price to earnings ratio, a popular valuation metric, shows stocks feeling the heat from higher rates. In other words, we're starting, as we've moved up, we've started to see that PE ratio come down. Now, you'll notice that their PE ratio is sitting at a slightly different level than the PE ratio that we used, which is right here. I want to show you where this data is so you could see and compare for yourself why these charts might look different. This is the Y chart, S&P 500 PE ratio. And when we pull that up right here, you could simply jump into it over here. You could see the 5-year on Y chart. So the 5-year on Y chart puts us at that 24.79. So, which is the same I have on my chart, although it's a slightly different chart that I was using. I think I may have been using macro trends. Yeah, that looks right. See, macro trends sitting over here at 27.40, though I think it's come down to about 24 as we saw that little edge down in the last few days. So I think Blackrock, it just has a little bit of a scale issue here, but I just wanted to clarify that because I did think it was a little weird that, you know, macro trends and the Y charts both have us at over a 24, and there's, you know, is suggesting S&P valuations are somewhere in that neighborhood of just under 21. So it's worth noting that their chart might be a little oopsie doopsied. So again, pay attention to that. But the point is the same. No matter we're sitting right under 21 or right under 25, it is historically well above the long run average of 15 to 16. And so those corrections can happen no matter from where. Again, I don't know why they have this. I think it's, oh, I know the difference. Look at this. Forward-looking estimates. Okay, we just discovered that live together. This chart shows the forward PE ratio. So the charts I showed you are the trailing 12 months, and the Blackrock is the forward. So they're already trying to price in how much earnings might grow and say, even with the future earnings growth, we are already high. So worth noting, glad we saw that together. Yeah, good for us to learn together. Okay, good. So what do we have over here? We question whether the slide in stocks is a blip or a bigger shift towards pricing in inflation. I think it's that. I think people have gotten a little complacent. They're like, oh, we don't mind if rates are at 5%. Okay, buddy, you'll start minding when you lose your job. You know, somebody else is like, Kevin, a recession can't happen in an election year. They would never allow that to happen. I'm like, bro, where were you in 2008? Where were you in 2000? Where were you during COVID? So crises can happen, okay? They can happen. All right, let's go in over here. So we have broadened out our stock view to include segments. All right, so that's actually a red flag. When people say, hey, I'm gonna diversify more into more stocks rather than concentrate, it means they're a little nervous the market might be getting toppy. So as a market goes up, you're supposed to diversify. And as the market goes down, you can concentrate on specific positions. Okay, got it. So earnings face a crucial test this week with some mega cap tech companies reporting. Yeah, 40% of the S&P 500 by market cap. That's a little more than some. But anyway, they do say that they do prefer artificial intelligence and staying exposed to AI. I think that's why they're still in, especially down the road AI applications like those that might be able to be found in healthcare, financials, and comm services. So they're a big fan of that. However, this argument that they are ready to pivot is something they reiterate multiple times. US benchmarks, we are ready to pivot once the market narrative shifts. Now that I thought was kind of like classic suit, rather than looking at underlying data and then deciding to pivot, which is what I do. They're saying, hey, we'll pivot once everybody pivots. Like, bro, you're Blackrock. Unless, of course, they're referring to the Fed's sentiment. But then again, those might be one and the same with the market, since the market seems to copy the Fed. But anyway, that's Blackrock's warning. And when you combine that with what Jamie Dimon said this morning, which I'll go through again in just a moment, look, if you're in, let's watch earnings. Let's pray they're good. I know people that are like, Kevin, how could you say you pray the earnings are good when you're cash? Because if the earnings are poopy-doopy, like truly poopy-doopy, it's just going to go into recession, man. It's going to set off a recessionary spiral, and that's bad. So that's what I want to avoid. We don't want a recession. Sure, I'll pick up a stock correction, but recession is just bad for everyone. Okay, so Jamie Dimon just spoke this morning, and he says that, here it is, when it comes to the soft landing, put me on the cautious side of that. He's commenting at the New York Economic Club. Even if we go into recession, the U.S. consumer is in good shape. Yeah, I don't know about that. They should have asked him why his charge-offs are up 70% in the consumer division year over year. Obviously, they didn't do that. And then, of course, there's the risk of stagflation. Okay, all right, whatever. Let's see what happens. I'll be live for Tesla earnings, so I hope you join me. Join me in that Stocks and Psych group linked down below at meetkevin.com. I'll also be in Sac and San Jose later today, and then tomorrow I think we've got Seattle, Spokane. I don't know. There's a whole list. Just go to househack.com/2024 if you want to meet me in person because you're curious about investing in househack. Read the solicitation. This video is not a solicitation. Thank you so much for watching. We'll see you in the next one. Goodbye and good luck.
Advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than househack, nor am I presently acting as a market maker. Make sure if you're considering investing in househack to always read the PPM at househack.com.